I think Bitcoin could establish itself as the new hurdle rate compared to all these traditional assets. And in fact, if you look at treasury companies today, like MSCR, they're using Bitcoin already as their de facto hurdle rate, right? It's not like they're trying to outperform the S&P 500, right? Which is considered to be like the market benchmark. They're trying to outperform Bitcoin. That's also like the incentive for other investors to buy MSCR common stock instead of Bitcoin directly.
Before we begin, let's make something clear. All views expressed in this podcast by me or my guest are purely our personal opinions. Nothing we say should be treated as a recommendation or an inducement to make any specific investment or to follow any particular strategy. This podcast is for informational and educational purposes only. It does not constitute financial, investment, legal, or tax advice. Before making financial decisions, you should do your own research and consult with a qualified professional advisor. Welcome to a new episode of the Digital Credit Frontier. Today, our guest is a European head of research at Bitwise, author of Exponential Gold. Welcome, Dr. André Dragosch. Yeah, of course. I'm really looking forward to our conversation. When I introduced the podcast, you were one of the first that I reached out to because I have the feeling that you can give us some really good insights on all the topics that I'm trying to cover, like Bitcoin as capital, like equity, Bitcoin treasury companies who are issuing fixed income instruments on top of it. Maybe you can do a little introduction about yourself, and then we can then do a 2025 recap.
Good idea. Yes. Yeah. Thanks again for the invitation. So yeah, my name is André Dragosch. I'm European head of research at Bitwise. And so maybe a bit of intro for myself. So I started venturing into crypto assets privately. I think it started in 2014. Essentially like the same kind of typical story that a guy who knew a guy like from university said like, you need to invest into like Bitcoin. But like Bitcoin back then, it moved from like $100 in 2013 to $2,000, 10x. And so that there was like this typical little narrative, like this or that is the next Bitcoin, right? And then we bought a bunch of Dogecoin, right? And the rest is history. You had like, I think the moment it clicked with Bitcoin for me personally was rather late, was like in 2018. And professionally, probably around the same time after like the retail craze in 2018, there was lots of interest about like crypto assets, blockchain, Bitcoin, right? And all of these topics. And then I was actually working at a mid-sized family office in Germany. And like my colleagues asked me like, why don't you write something about like blockchain tech and all that stuff? And I did write that was like essentially my first research piece, like a 30-pager on Bitcoin, blockchain, and all of these topics. So that's also when my professional career started. And I think since 2022, I've started working full-time in the space, already as head of research. But I used to work in portfolio management, investment research my whole life, right? Also in traditional financial sector, covering all kinds of assets, equities, bonds, commodities. Yeah, but working full-time since 2022. And since 2024, I'm part of ETC Group / Bitwise because we've been like acquired by Bitwise. ETC Group's been acquired by Bitwise last year in December. And since then, we're part of this big Bitwise family, and Bitwise itself is like a specialized crypto asset manager, right? We only manage money in crypto assets, right? So we have big Bitcoin ETF in the US, right? We have ETPs in Europe. One of the first Bitcoin ETPs in Europe, in fact, was launched by ETC Group right in 2020 on Zeta, which is the Frankfurt Stock Exchange. And yeah, we managed around $15 billion already across all kinds of strategies. And I already have 120 or even more colleagues, 120 and counting, because every time I go on Slack, there's like a new hire. So we're also hiring a lot and growing a lot. and we're really happy to. So I'm personally really happy to be part of this family. And yeah, so far so good. And yeah.
All right. The fact that you pointing out that Bitwise really like this crypto focused company. I when I talked to Jeff Walton a few weeks ago, I also I make the comparison between Strive and Strategy and BlackRock and Bitwise. That how can you differentiate from each other? Maybe Bitwise can't get bigger than BlackRock, probably, but you can differentiate on fact. Like I know that Bitwise trying to be this company that really gets crypto, Bitcoin, like the underlying. I think you're the only one who doing like proof of reserves, where others
Exactly, yeah.
don't do it. So yeah.
So there are like a couple of special characteristics of our ETP. So proof of reserves is one characteristic. So we publish our on-chain addresses and also the liabilities, of course, but like the on-chain addresses with all the Bitcoin assets. We do it for Bitcoin. We also do it for Ethereum. We also do is we donate 10% of our profits in the Bitcoin BITB ETF to open source developers, right? So in order to like nurture like the whole ecosystem. And yeah, I think that's one of the key things that differentiates from like other competitors, plus research, right? I think many of these bigger companies, especially like BlackRock, they don't have like dedicated research, right? They're more like generalists, to be honest. They cover all kinds of assets, which is also good, right? It's fine. It's a good strategy. I mean, it worked out well for BlackRock, obviously, right? But we are more like the crypto specialist.
Yeah, this is reminding me of something I wanted to ask. It wasn't on my list, but now I'm reminded of it. Do you want to share some of your morning routine? Maybe it's personal, but I check X, and I most of the time you're already posting charts and stuff like that, like at 6 in the morning. Like, are you really trying to do some research before? Like, yeah, you have to bring the kids to school, or is it because of the time zones? Or can you share something about that?
Yes, that's right. So I tend to get up quite early, like usually at 5 a.m., right? And then I have a very quiet morning routine, right? Just drink some coffee. Also check out X, right? But because in fact, I do have like two small children. So I start working a bit earlier just to be ahead of the curve, right? Before like the breakfast routine and like school and kindergarten routine. And so, yeah, I do like both some research of narratives, current investment narratives, and also like create own charts and just post, right?
Yeah, awesome.
You mentioned my book, right? Exponential Gold. It essentially that book is the product of these like 5 a.m. morning routines, right?
Oh, really? Oh, awesome.
Yeah. And it's like it's incredible how much you can achieve with compounding, right? Like I wrote that book, to be honest, like it took me 9 months. It took me 9 months of like early morning writing, but consistent writing every day, right? Like 1 to 2 hours of writing and reading, right? But at the same, yeah, it just goes to show that there's so much power in just like tiny steps,
Yeah.
but consistent tiny steps and this power of compounding, right?
This
Yeah.
is really awesome because you really sound like Jocko Willink right now. I don't know if you know Jocko Willink. He's that Navy SEAL. He's that ex-Navy SEAL, and he's always talking about staying ahead of the curve. So like Navy pilots or like Air Force pilots are saying like you have to be uh, in front of the curve because there's like this power curve that if you get below it, then the plane might stall and crash. So he's always saying that, and always he's also telling people to get up early, 5 a.m. and doing those first important things before the day starts. So that's awesome.
Sometimes I actually manage to go to the gym, but I don't do like 5 a.m. gym stuff every day. I can't do it. Like it's too tough for me. But yeah, but I tend
Yeah.
to work a lot like in the early morning hours. And yeah, I think there's probably some kind of window where you can also concentrate the most. But that's probably a story for another podcast.
Yeah. So maybe we can start with the 2025 recap. Was this year what you expected, or did it turn out to be different? How would you summarize last year?
I think the word is disappointing. Like, to be honest, I was among those analysts that went into 2025 being very bullish, right? Because of ongoing institutional adoption, not only by treasury companies, right, but also ETPs, right, exchange traded products. And in fact, I think most of the bullish predictions actually materialize, right? For instance, the fact that the US government and the Trump administration actually did establish a strategic Bitcoin reserve, right? That was the bull case, like going into 2025, right? We saw massive buys by both treasury companies and ETPs, so massive institutional adoption. Yet the price did do like new all-time highs, right? Hit new all-time highs. But at the same time, the year-to-date performance, like the full-year performance, was rather flattish, slightly negative, right? So as if nothing happened, right? Essentially ended the year as we started it, despite all these bullish tailwinds, right?
Yeah.
And I think it was mostly due to coin-specific factors, especially the fact that long-term holders took so many profits, right? And but I do think, despite this kind of long-term holder selling, I think the macro environment stays very positive, right? Plus, in my view, Bitcoin is rather undervalued right now. So you're moving into the new year, 2026, with an undervalued asset, right? And also a very robust macro environment. For me, it's a very attractive environment to add exposure, right? Because I don't believe we're entering a bear market right now. To the contrary, I think the bull market will continue well into 2026 because the global growth environment, the risk appetite will stay relatively robust. And so, yeah, we can talk about the reasons why long-term holders took profits and so on. And also, so one of my thesis with respect to long-term holders, the bull cycle, 4-year cycle in general, I think what was quite striking though was I think we peaked almost to the T, right? As suggested by like the previous halving performance pattern, right?
Yeah.
In terms of like the median performance, right?
Yeah.
I think we peaked to the T, almost to the day, right? And we went like 35% down, right? So we're 35% drawdown, peak to trough. But my counterfactual argument is, with respect to the bear market, the 4-year cycle, and so on, is I think if we didn't see these kind of bullish tailwinds, i.e., like institutional adoption, sovereign adoption, so strategic reserve, and so on, I think we would have entered a classical bear market, right? Because the amount of long-term hold selling is very similar to previous like cycle peaks, right? Cycle tops.
Right.
It's very similar. And but I think a large chunk of this profit taking, this long-term holder selling, was absorbed by institutions, right? Who themselves are also long-term holders. So there was essentially like a shift, a transfer of like from strong hands, who used to be strong hands, right? They of course they sold, but usually strong hands, long-term holders, to new long-term holders, to new strong hands, because we know that these ETPs on ETP investors, right, on aggregate, and also treasury companies on aggregate, they tend to be strong hands, right? They don't like distribute a lot of coins, especially like if we even start talking about MSCR, right? I think there was one sale that they did like 2023 based on some on-chain data. I think Arkham Intelligence that shows some kind of drop in 2023. But apart from this kind of drop in Bitcoin holdings, MSCR hasn't sold a single set, right?
No.
They're one of the key like diamond hands.
Yeah, I
And
see. Sequans was the only last year that really announced that they sold some to delever. That
exactly.
they, yeah,
Like, but on aggregate, that like very strong hands, like they're very long-term hold, they're long-term holders
correct.
in nature, right? And
Yeah,
so, yeah, I think that's why I'm optimistic from the on-chain side,
hmm
because despite the fact, for instance, that we had like a 35% drawdown in price, right, which was most likely induced by this long-term holder profit taking, we haven't really seen significant distribution by these institutions, right? We haven't seen massive outflows
no,
from global Bitcoin ETPs. We haven't seen massive sales by treasury companies, right? We have seen like a deceleration in institutional demand, though, right? But it's not material. It's not like they sold aggressively or anything.
no.
But
So
yeah,
there was a lot of trading volume in the on the ETPs, but there was not a net outflow. So there was a lot of like shares in changing hands, but not a net outflow. So there was just a
yes,
few
exactly.
percentages. So that shows that there is enough new demand at these prices for others to take those positions in. Yeah.
Exactly. I mean, we did see some outflows when we hit that cost basis, right? Around 80,
Yeah.
81K, which was also the IBIT cost basis, but also the aggregate US spot Bitcoin ETF cost basis around 80, 81K. We did
Yeah.
see like record outflows, especially in IBIT, but that in itself is like a contrarian indicator, right? If you see like record outflows, because it implies like seller exhaustion, right? And
hmm
so, but that being said, from a big picture point of view, if you look at cumulative inflows into EDPs, that was maybe a 1-2% drawdown in these cumulative flows, right?
Yeah. Yeah.
Despite this massive drawdown. So I totally agree. Like these ETP investors, they seem to be like there seems to be a lot of conviction among these investors, right? On
Yeah.
aggregate, at least.
So for the sake of the conversation, I saw people and like I'm doing some analysis too for the Bitcoin layer, and we did hit some, like we went below some thresholds that I would say, like technically, if you look back to other cycles, we went into a bear market. I do expect that we don't go as low as other cycles, other bear markets, but like, could you call this like maybe for now a mini bear market? Would you agree with that? And also, like, where do you looking to, like, to what indicators or to what trends do you watch to consider when the trend is up again? Because we are in a downtrend, or we're now like consolidating a bit, trying to find a bottom maybe. Yeah, when do you change your mind again, or when do you think like now it's the momentum is picking up again, or the other side, that maybe there's this air pocket below us to 75K, maybe we're gonna test that. I don't know
So
how.
I remain relatively bullish for 2026. From the on-chain side, I think let's talk about the risks first, right? And then opportunities. So
Yeah.
talking about the risks, I think what happened, especially after the 1010 liquidation in October, was there was some kind of shift in market psychology, right? The market psychology changed from buy the dip to sell the rip,
Yeah.
essentially, especially among short-term investors. You saw that once, for instance, there are metrics like a short-term holder SOPR, so spend output profit ratio, which essentially shows like the ratio between like spent bitcoins either in profit relative to losses, right? And so an SOPR ratio of 1 implies coins are being spent at break even, right? At below means okay in loss on aggregated, and above 1 means okay there's mostly spent in profit, right? But what we've seen after like the 1010 liquidation event is the metric went below 1, right? So most of the coins were spent in loss, right, on aggregate. And the moment we hit break even, you saw these profit takings again. or like sales again, right, where that ratio went significantly below 1. So how to interpret this is like short-term holders, they broke even and they immediately exited their positions just to break even, right? And that's why we've seen like these short-term rallies to around 93.5K, which is like the critical threshold because it's the last year's open price. 2025's open price around 93.5. And what we've seen so far, we bounced off many times off this level. And we also defined internally that's one of the key levels to watch, right? So that market psychology shifts, short-term holders stop taking exiting positions at break even so that we can start moving higher. But I think the risk going into Q1 at least, it's rather a short-term risk because we only see these kind of exits by short-term holders mostly, right? And this kind of a new market psychology, which is very akin to a bear market, to be honest. But like, yeah, that being said, I think it's rather short-term risk because long-term holders, they're still above water, right? They're not in like loss zone on aggregate, right? And in fact, we already seeing a deceleration in long-term holder profit taking, right? We've already seen this. At the same time, we're seeing like a kind of reversal in institutional demand, which also decelerated in Q4, right? So we are already seeing like a reversal in institutional demand across like ETPs, across treasury companies. And one of our key predictions is that in 2026, that Bitcoin ETFs, they will buy up more than 100% of the new supply. So they'll buy up the whole new supply again, which they did in 2025, despite the fact that it was like a mini bear market, right? They bought like 200,000 Bitcoins, which is more than 100% of the new supply. The new supply is around 164,000 per year.
Yeah.
Treasury companies, they bought despite the bear market or mini bear market, they bought like 420,000. MSCR, I think, was 200,000, accounted for 200,000 of this. So combined they bought around 620,000. And in terms of ETFs, we expect this to repeat in 2026 because of ongoing institutional adoption. You saw the screen lighting by Vanguard, Bank of America, Wells Fargo, all of these major wirehouses who have tens of thousands of like financial advisors. Like Bank of America, then they are already recommending 4% allocation to crypto assets, right? Bitcoin and other crypto assets. Morgan Stanley just announced to launch their own Bitcoin ETF, right?
Yeah.
So it's like, I think institutional adoption going into 2026 will continue to accelerate. And as far as strategy companies are concerned, I don't see any kind of buyer fatigue by MSTR. To the contrary, like MSTR keeps on buying. They just announced like the highest purchase since July 2026, 2025 last year, right? And so around 13,000 Bitcoins, right? And I think as competition, especially among treasury companies, ramps up, right? Because we haven't seen like new treasury companies like 21, like BSTR, right? They haven't even started buying, right?
No.
And I think 2026 will be the year where you have like a bunch of big treasury companies that will start competing for Bitcoins. And that could be really interesting. I know like Seda hates competition, like the word competition itself, apparently. But I think this will ramp up, like the race for the corporate adoption of Bitcoin will definitely speed up, I think, this year. And that could create an environment where like treasury company buying also accelerates. And if ETFs soak up the whole new supply and treasury companies do like the rest of the heavy lifting, I think prices should grind higher the moment you see like a decline in profit taking by long-term holders. And to your question, whether it was like a mini bear market or like a genuine bear market, I think, I mean, like a bear market in itself hasn't been like really defined, right, in terms of Bitcoin, right? Nobody knows. It's like the threshold for a bear market is like 50%, and like 80%. For the S&P 500, it's 20%, right? But we all agree, like, because of higher volatility, that threshold should be lower. So let's say if you took a threshold of 50%, you can actually capture all of the previous bear markets, right? Even like the COVID drawdown, which was cycled around 50%. But so based on this kind of definition, I think we haven't seen a bear market yet, right? And I also think that in the future bear markets won't be as deep as they used to be, because like as a general rule of thumb, because of declining volatility, like the drawdown itself should also be more shallow, right? Because Bitcoin's volatility has dropped significantly over the past like 15 years, right? And so if you multiply, so the rule of thumb is you multiply like the standard deviation, the volatility, by a factor of 2, and then you end up more or less with like the maximum drawdown, the potential maximum drawdown, right? So we have a standard deviation of around 30%. That would imply a max drawdown in the cycle of 60%, right?
Yeah.
But not 80 or 90%, which we have seen in previous like bear markets. So I genuinely believe we haven't seen a bear market. It was probably like an interim bull market correction. And previous interim bull market corrections, in fact, they have been between like 30, I think the mean was 32%. Right. So we had a similar kind of correction in terms of drawdown size. In terms of duration, they lasted a bit longer. So I do think there's definitely the risk that we continue to consolidate in Q1.
Yeah.
And yeah, but like all of these major drives, especially towards institutional adoption, and like how is institutional demand influenced, right? How by which variable is institutional demand affected the most? It's macro, right? Like it's not the halving, right? And by the way, talking about whether the 4-year cycle is dead or like the halving effect is dead, like if you just compared quantitatively, so institutional demand was around 620,000 Bitcoins last year, right? And the supply deficit induced by the halving, right, in 2024 was around 164,000 Bitcoins annualized, right? So if you just compare these two numbers, 620 compared to 164,000, so institutional demand outweighed the halving supply deficit by around 4.2 times, right? So I think from a pure quantitative perspective, the halving, I wouldn't say like the halving is completely irrelevant, but like it probably won't play such a large role in the future as it did in the past, right?
Yeah.
And yeah,
only the fact that maybe the mining companies not even sell them is already like that's the first step. Like if they don't sell the Bitcoin, like they're the ones that dampening out the whole 4-year cycle, like the mining issuance already. And then you have on top of that, you have the institutional demand where you're talking about. Well,
exactly.
something that I thought was worth mentioning is I'm trying to extract data from a Deribit, and I'm tracking the put call ratio per quarter. And so for January, the PCR is quite bullish, like 0.5. But if you go further out in March, I think it's 0.7, and in June it's 0.9. It's the highest, so it's the most bearish. And from September, it's getting more bullish again. So I think this maybe also this is people like during the fourth quarter of 2025 positioning for maybe like buying insurance for maybe a bear scenario for 2026. But I thought it was interesting also because James Check he had this great chart about the PCR ratio between IBIT and Deribit, and there was a big divergence in August. Like people on IBIT were bullish, like PCR ratio of 0.5. But since August, the PCR ratio on Deribit was increasing up until to October, and when the crash came, then the PCR, like this whole divergence, converted again.
Yes, it makes sense. What I tend to look at is also option skew, right? 25 delta option skew. And that tends to be more of a coincident indicator, right? So if you have like a high put skew, like so the implied vol is more skewed towards puts, right? The high put implied vol compared to calls. That tends to be like a contrary indicator for like a tactical bottom, right? And we did see like a tactical bottom in November, right? I think 21st of November was like the peak of this kind of skew, option skew. And and since then we actually reversed a bit. I think there's still an imbalance towards puts in the market in terms of like option skew 25 delta. But I think in general there's some kind of shift happening already. So there's like an slightly increasing call demand again. But yeah, I totally agree. Like there was a big divergence between IBIT options and derivative options. And I think it speaks volumes in terms of like the sentiment among like institutions versus retail, right?
Yeah.
Although we do see like institutions trading on Deribit, right? In general, I think the IBIT options volume was way, way more bullish than the Deribit volume, right?
Yeah.
Options volume. And so, yeah.
But maybe there was also, and that's what you're alluding to. I think I don't want to put words in your mouth, but maybe it is also this PTSD from like native crypto investors who thought, all right, this 4-year cycle, I need to protect myself because we're going to shit again, and they maybe went through it once or twice, and they think it's not gonna happen to me a third time. So I think you really saw like a divergence between like crypto native investors and the more TradFi people.
I think so too. And maybe a couple of observations. I mean, there was also Bitcoin OGs, right? And I'd say like Bitcoin OGs are very sophisticated investors, right? Like most famously, Roger Ver, he dumped like 80,000 Bitcoins, right, in the summer. He was none of these like long-term holders who distributed Bitcoins.
Yeah.
And maybe it was also the belief among these sophisticated long-term holders / Bitcoin OGs, this belief in the 4-year cycle. I mean, they'd witnessed these cycles over and over again. The question is, in general, like, have we really seen these perfect 4-year cycles in the past? Or because many people do disregard like the 2011 and 2013-14 spike, right? When they talk about the 4-year cycle, although the distance between these kind of two bubbles was way less than 4 years, right? But many people disregard the like 2011 kind of cycle. But that being said, I mean, there's also the question whether like these 4-year cycles have always been caused by the macro cycle, right? And not the halving cycle. Because there's a funny coincidence between like US business cycle troughs in the ISM manufacturing index and halving events, right? Which also happened like in 2012. That was like business cycle trough, 2016 business cycle trough, 2020 because of COVID, right? And so on. So if it's kind of funny coincidence. And to be fair, we only have like 3 observations, right? Like we have 3 historical observations, like the 4 to be fair, but like I think the halving effect already broke in 2024 because and what was a bit of evidence for this that the halving effect was becoming more and more irrelevant was we saw all-time highs before the halving, right? New all-time highs. And the previous performance pattern was you saw the halving event, then you saw like all-time highs, I think following, I think it was like 400 or 500 days after the halving. That was like the historical performance pattern. But with the launch of the US spot Bitcoin ETFs in January 2024, we actually saw like all-time highs before the halving, and everyone was puzzled. But I think that actually this kind of event spoke volumes in terms of the dominance of demand versus supply, right? I think we're now, like Bitcoin has become much more demand driven because of institutional adoption and so on, and not so much supply/halving driven.
Yeah, so like investors, they front run like the start of the cycle, and they front run the end of the cycle. So
Yes.
all trying to beat the market and be smarter, and maybe some achieve that. But I want to go into the thread that you wrote on Twitter about the hurdle rate, because people were asking like what is the hurdle rate, and I think that's also a great segue into the other topic. So maybe you can elaborate on what is the hurdle rate and how is it being used.
Yeah, I thought this was an interesting Twitter thread because there's this kind of saying, "Oh, Bitcoin is the new hurdle rate," right? But what does it even mean? Where does it come from? And where does it come from? So it's a concept from traditional corporate finance, and it's essentially the way corporate decision makers appraise investment projects, right? So what they ideally want to achieve is that their cash flow, discounted future cash flow from any kind of investment project exceeds the initial investment, right? The initial negative cash flow. And usually this kind of discount rate, which equates like the initial investment with like discounted future cash flows, is called internal rate of return, right? That equates both of these sides. And usually you want your future discounted cash flows to be higher than your initial investments, right? And a way to gauge this is via the so-called hurdle rate. So any kind of investment project needs to have a higher return than the hurdle rate. And you automatically end up with essentially a net present value of the investment that's positive, right? So that's also economically viable and sensible and so on. And how does Bitcoin come into play in this kind of context? So usually,
sorry to summarize. Basically, you want to measure like your investment against a benchmark, and you want to outperform the benchmark, because else the investment you shouldn't do the investment in the first place, right?
Exactly. So the hurdle rate is somewhat of your opportunity cost of capital, right? And usually what you use is the cost of capital, weighted average cost of capital across equities, bonds, and so on, right? So you have a certain cost of capital, which is also, by the way, at the same time, like your opportunity cost, because you can, of course, refinance yourself at this kind of weighted average cost of capital, but you could also decide to invest into these assets, especially like public equities, right? Public debt, and so on. And so the hurdle rate is essentially your opportunity cost of capital. In the traditional world, like what is like the typical expected return for like the S&P 500, right? I think over the next 10 years, it's probably around 3 to 4% in normal terms, because valuations are already so high, right? Bond return for like a AAA corporate bond, right? 10-year bond, probably like 4 to 5%, maybe. Preferred equities around 6% dividend yield, right? So, but at the same time, if you look at things like the power law, right, rather conservative models, performance like price prediction models for Bitcoin, they imply already 30% CAGR, right, per annum for Bitcoin. So on a conservative basis, our official prediction at Bitwise for like the 10-year prediction is also around like 30%. But yeah, that being said, so 30% Bitcoin opportunity costs, right, per annum against like these traditional returns around 3 to 4%, for instance, for like the S&P 500. It's very juicy. It's very much different, right? And I think Bitcoin could establish itself as the new hurdle rate, right, compared to all these traditional assets. And in fact, if you look at treasury companies today, right, like NSCR, I mean, they're using Bitcoin already as their de facto hurdle rate, right? It's not like they're trying to outperform the S&P 500, right? Which is considered to be like the market benchmark. They're trying to outperform Bitcoin, right? That's the whole point. Like that's also like the incentive for other investors to buy MSCI common stock instead of Bitcoin directly, right? And so I think the whole hurdle rate discussion also goes a long way towards explaining why is, for instance, MSCI moving away from issuing common stock, right? And rather issuing preferred equity, right? And one of the explanations based on this kind of hurdle rate rationale is if you consider like the return that investors expect from an investment into MSCI common stock, how you can derive this is via the capital asset pricing model, right? That's also the way you calculate the cost of equity capital, right? So by the capital asset pricing model, you assume your fair expected return for MSCI common stock to be like the risk-free rate plus beta times the market benchmark, right? Minus some kind of risk-free rate, so some kind of equity risk premium. So, but in this case, we know the market benchmark is not the S&P 500, it's Bitcoin, right? So it's like the risk-free rate was probably around 4%, right? The money market fund return plus beta, and the beta of MSCI common stock has been around 2, right? More or less, because it's relatively more volatile than Bitcoin, right? So you have a beta of around 2, let's say, times more or less Bitcoin's performance, which is around 30%. So the MSCI's common stock needs to yield around, let's say, 60% to be attractive, right, for an investor. And now we know Bitcoin's performance expectations, they have somewhat declined because of institutional adoption, right? Volatility has also declined, right? But at the same time, let's say performance expectations have declined. So it's only around 30%, which is still very juicy compared to traditional assets. But let's say it's only 30%. Then it doesn't really make sense for MSCI to issue common stock, because if their cost of capital is around 60, but they're buying an asset which only yields 30%, it doesn't make sense in terms of our hurdle rate. Right? They have higher cost of capital, they have a higher hurdle rate. Buying Bitcoin doesn't make sense, right? Only if like they have at least an MNAV of 2, right?
Yeah.
Because then they match in terms of then they match the cost of equity capital, right? Because then they're essentially getting more money to buy more Bitcoin, right? When they issue common stock. But like, because they now have an MNAV which is closer to 1, it doesn't really make sense. Now, it makes sense, though, to issue preferred equity, because if you look at the dividend yield of, for instance, Strike, it's around 8%, right? And 8% is lower than the 30% expected return for Bitcoin. It's just like, yeah, and so they're essentially pivoting away because, for one, like this hurdle rate is being decreased, their cost of capital is being decreased if they issue preferred equity rather than common stock. Right. And it makes more sense from an economic point of view because their cost of capital, their weighted average cost of capital is way lower if they issue preferreds rather than issuing common stock, right?
Yeah. So, but if I want to make some comments on what you said, because 60%, I mean, you almost have to be levered up 100% on your balance sheet if Bitcoin goes up 30%, because now they have an amplification rate of 30%. Would the calculation comes out like Bitcoin gains 30%, they gain like 1/3 more, like, and then they end up going up 40% versus Bitcoin 30% with a 30% amplification? Or is that too simple?
This is more like the equilibrium kind of condition, right? That can change over time, right? It's very dynamic. But what I'm actually referring to is this kind of infinite money glitch, right? If their common stock trades at like 2 or 2.5 NAV, right? Then they're essentially printing money because they're issuing common stock at like 2.5 times the Bitcoin valuation of the assets, right? But can buy like the same Bitcoin, right? Like, or 2.5 times more Bitcoin. And so I think that was That's what I meant in terms of like this kind of infinite money glitch. But
those high MNET, those are unsustainable, right? Like two
I
and
think
a half.
like that there are like two elements in MNAV, right? So one element is like cyclical and the other element structural, right? We know like
Okay.
MNAVs over time, right? They follow an inverse power law, right? It does make sense because like if you're MSCR and you're like 670,000 Bitcoins, it's harder to double your stack, right?
Yeah.
Than Metaplate, right? Which is way smaller. So like from a structural point of view, your Bitcoin yield declines, so your MNAV multiple also declines, right?
Yeah.
And so that makes total sense. At the same time, I think there's a cyclical element, which is, in my view, essentially tied to Bitcoin performance expectations, right? So the moment you see like increasing performance expectations for Bitcoin, let's say you see higher contango in the futures curve, right, of Bitcoin, essentially a higher basis rate. What you usually see as well is like an expansion of the MNAV, MSCR's MNAV. So I think my personal expectation is at some point MSCR's MNAV will expand again, not only because they increase their BTC yield, but because there will be increasing performance expectations for Bitcoin during like the next upturn, right? We've moved into a price correction, right, in Q4. It's totally consistent that like the MNAVs have compressed, right? Because of like lower performance expectation. But yeah, my thesis remains for 2026. Like the moment we see like a renewed return risk appetite, increasing basis rates, so increasing like futures performance expectations, like MSCRs, MNAV will expand. I don't know whether it will reach 2 point or like 2 times or like 2.5 or, but I do think it will definitely expand from here. And like the MNAV itself, based on like the BTC yield, the performance expectations we have for Bitcoin this year at Bitwise, like officially we expect like new all-time highs, so at least 126,000. Yeah, I think there's definitely scope for like a cyclical expansion, at least in like MSCR's MNAV.
Yeah. What's interesting is that the chart of MSCR USD is similar to Bitcoin versus gold. And because MSCR peaked in December 24, when Bitcoin versus gold peaked, and now we're basically already like 12 or 13 or 14 months in the downtrend. And I was just checking, I've made like 155 volume weighted average from MSTR. So that's basically your short-term holder cost basis. And we're almost at the same levels as we were in the bottom of the bear market in 2022. And also with the MNAV, with basic shares, I'm using also enterprise value, but we're also at the same level as the, like we're 0.78, like, so in MSCR terms, like it feels like we're getting close to a bottom, or if I compare it with the other cycle, we're it looks like we're getting to the lows.
I think it just makes total sense, right? But there's a high correlation between like Bitcoin and gold and MSCR and Bitcoin, right? Because so for me, Bitcoin versus gold is like a risk on, risk off kind of performance ratio.
Yeah.
So Bitcoin tends to outperform in the risk on environment. Gold tends to outperform in like a risk off environment, right? And as MSCRs, it's very much the same relative to Bitcoin, right? Like MSCR is a bit more volatile, at least than Bitcoin, right? It's more risk on, it's more risky, which is why it tends to outperform risky, like in the kind of bull market, right? And vice versa. And so it makes total sense that there's this high correlation. And in terms of Bitcoin versus gold, I think we're also close to the bottom, right? If you look at relative valuations, if you look, for instance, at the relative Mayer multiple, it's at FTX blow up levels. It's at the lowest level since end of 2022, right? If you look at things like the 19-day rolling Z-score, it's at like -3, -2 standard deviations, like very much oversold, like the Bitcoin gold performance ratio. And yeah, MSCR, you mentioned MSCR Bitcoin, it's very much the same, right? It's both undervalued and oversold. And so I think there's definitely asymmetric upside once we see like a return in risk appetite, which I think is very much likely because for me personally, Bitcoin from a pure macro perspective prices in a recession. Like the pricing is so depressed already. And what we did from a pure quantitative perspective at Bitwise is we actually derived what Bitcoin is pricing in terms of macro, in terms of global growth conditions. And it does price a recession, while at the same time leading indicators like Philly Fed manufacturing expectations, Empire State manufacturing expectations, all of these very forward-looking indicators, they're actually moving higher and looks like they're even accelerating because of preceding the amount and the number of preceding rate cuts across the globe, not only the Fed, but across the globe, across the G20 central banks. And it actually implies that we'll see like a further reacceleration, at least 6 to 9 months moving into 2026. So on the one hand, Bitcoin's pricing a recession. On the other hand, like moving like forward-leading indicators actually moving higher, right? There's some kind of mismatch. And I think the moment the market realizes, okay, there won't be a recession, right? To the contrary, even like labor market indicators, they're improving, right, in the US and so on. I think the moment the market realizes this, there will be a kind of catch up to the upside. And yeah, a return risk appetite, which will most likely lead to a change in this performance leadership, right, between Bitcoin and gold. So where Bitcoin tends to outperform gold, it doesn't necessarily mean that gold will like crater or crash, right? It just means that Bitcoin will have a higher performance than gold, which does make sense because what we also do at Bitwise, we probably you've seen this kind of tile chart where we show like cross asset performances like for every year, right? And maybe 2 observations on like Bitcoin's cross asset performance. Bitcoin either tends to be the best performing asset or the worst performing asset, right? There's like nothing in between, right? Either best or worst. And Bitcoin has never been the worst performing asset 2 times in a row, right? In any like in any year. And it has been the worst performing asset last year. In 2025 was the worst performing asset. Like it underperformed equities, underperformed gold, obviously, silver, right? It even underperformed US Treasury bonds, right? So it was like the worst performing asset. And yeah, I think there's a high chance that this performance leadership will change in 2026, and that it's quite likely that Bitcoin could be, as implied historically, be the best performing asset again, right?
Yeah. So we're almost nearing 60 minutes, and I really want to ask you some other questions. One thing I wanted to get your opinion on is like the terminology that Saylor uses. And so on Twitter, there's a lot of debate, and I want your opinion. So 2 things: terminology, digital credit. Is it basically we know it's not credit, but it acts like credit, it behaves like credit. Do you think it's like appropriate terminology, or do you think it's misleading?
No, I think it's appropriate methodology and terminology because it's essentially just a collateralized credit, right? You could also talk about asset-backed kind of securities, right? Especially like mortgage-backed securities, and there are all kinds of asset-backed securities, right? There are even securities backed by auto loans, right, or even credit cards.
But those are those are all debt. And this,
those are all debt, and it's like fiat. These are fiat assets as well, right? Maybe with the only exception of like mortgage-backed securities, which are backed by real estate, right, hard assets. And I think in this,
those, because now you're basically hitting on my point that I want to talk to you, because like the instruments, those are perpetual preferred equity. It's not debt. It doesn't have to be repaid. And if a strategy were to issue debt, it's getting below the debt in the seniority in the capital stack. So you have to trust me. It's like, trust me, bro, we'll never do that. So that's one like critique. And the other is a word that I want to check with you is Bitcoin backed, because it's not really like those mortgage backed securities are really backed by the real estate, because those are mortgages that if they default on a loan, you get the house. And if strategy is defaulting on their dividend obligations, you don't get the Bitcoin. So like, is it credit, and is it
I think what both, like, for instance, mortgage-backed securities or mortgages in general and housing have in common with Bitcoin is both assets are backed by energy, right? You need energy to build a house, right? You also need time to build a house. You need energy to mint Bitcoins, right? And so I think the innovation of Bitcoin is that you transfer physical, real world scarcity, right? And real world energy, which is real, right? It's like tangible, into like the digital realm. And that's the innovation of Bitcoin via proof of work, right? And so I do think like both housing and Bitcoin, they are backed by something very tangible, which is energy. And yeah, so it's called digital credit. And I do think that that's why many people allure to Bitcoin as being like a hard asset, right? Because the reason why it's finite, the reason why it's scarce, is because it takes so much energy to produce Bitcoins, right? You can't print it, you can't create it out of thin air. And you have real world physical constraints, right? That's why you can't like print houses, right? You can print 3D print houses, right? But like you still need energy and time to do so, right? And yeah.
So yeah, it makes a lot of sense to have like this appreciating collateral, as you will, like backing or linking to the instruments. I think that makes a lot of sense, because
Yes.
and this is also for the audience, and this is something I think that a sailor gets frustrated by. It's like there's a lot of critiques, and like Bitcoiners should be critiquing or asking questions about anything, because well, they hold persons and businesses accountable, and I think that's a good thing. But I think a sailor gets frustrated by the fact that I got this physical mailing like a few weeks ago from a company that wants to issue corporate bonds for 6% yield. And if you then compare it with something like Stretch, like this corporate bond it's with a 5-year maturity. It's like it's private. You cannot sell it. You cannot calculate the risk on it. You don't know if the company is still good for the money. You don't know how the development is, what they're trying to build. And then if you compare it to something like digital credit or the perpetual preferred equities that they're issuing, it's like on so much fronts much better. And I think he's frustrated by the fact that Bitcoiners should be more focused on all the instruments that aren't backed by credit or backed by Bitcoin or are just inferior, right?
Exactly, yeah. Considering the fact that these instruments are more or less backed by Bitcoin, right? They have different coverage ratios, right? But considering the fact that they're all backed by Bitcoin and still yield at least 8%, right? In the case of a strike, right? Is mind-blowing, right? Because I think the usual dividend yield you see on like US preferred equities around 6%, maybe 6.1, 6.2%. Yeah, but they're not backed by Bitcoin, right? They're essentially backed, yeah, they're backed by the company's assets, but they're like also in terms of like the seniority, they're above like common stock, but still they're like at the one of the lowest levels of seniority within like the capital structure, right? And so not backed by anything and still only yield 6%. But
Yeah.
I think my personal expectation for MSTR is they moved away from common stock because of this MNEF contraction and so on, which is structural but also cyclical. But they moved away from like common stock to preferred equity, and it's somewhat of a niche, right? Because it's also like a hybrid instrument. It's a mixture between equity and credit, right? But at the same time, I think at some point they move towards credit instruments like real corporate bonds, not hybrid instruments, like with higher seniority in the capital structure, but also then lower yields, right? Because from an economic point of view, that makes even more sense, right? But I think because they still had only a credit rating of, I think, B minus. B minus is still junk, right? I think the threshold, you need to have like a triple B rating to be considered investment grade. And then you have like decent, acceptable interest rates, right, on your corporate bond.
Yeah.
Right? So he's still in the junk bond sphere. He's still kind of speculative high yield sphere. So he'll probably end up paying like still 7 to 8%, right, as a high yield bond issuer, which is probably not like justified considering like the growth outlook and everything, like this credit rating in general, B minus. But like, I think that's why he's still refraining from issuing like credit instruments because his credit rating is unjustifiably low. But I think the moment he moves towards investment grade, I think you'll see like a higher likelihood that they start issuing investment grade bonds and like refinance at even lower interest rates. You know?
I would take the other side of that bet, because I think he mentioned that Strive will be always be top of the capital stack once the convertible debt is gone, and he really said this will be the crown jewel of fixed income. And if he issues like real debt, then he devalues the credit rating of Strive. And it could be maybe because he's like, it's a journey for him too, and he's like innovating. Like every year he's trying to reassess what they're doing if it's the right thing. So I agree that it's more that it's non-zero, so it's probable, but I wouldn't say it's possible, but I think it's not probable, but we'll see. If there's is there something that I missed that I should ask you, or that you really want to point out?
Interestingly, I think one of the key views that I have, we talked about the recession aspect, the underpricing of Bitcoin. We talked about the hurdle rate. And I think in terms of like the cycle, we also talked about like 4-year cycle. I think we covered almost everything. I think
Okay. So that's great. So tell people about, I think you're doing these monthly webinars. Or like
yes,
also,
exactly.
Yeah. So where can people find those?
So you can find the monthly webinars at our website, bitwiseinvestments.eu. So we do a monthly webinar called Bitcoin Macro Investor Webinar, which is also like a part of like a monthly report, the same title, Bitcoin Macro Investor Report. We usually publish it at the beginning of each month, usually the very first business day of each month. And I do this webinar with our head of Europe, Bradley Duke, and also the CIO of Bitwise, Matt Hogan. And we focus on Bitcoin topics, obviously macro topics. And you can find it on bitwiseinvestments.eu. And I think you can also follow me directly. I'm very active on Twitter in the early morning hours.
Yes, you are.
And my handle is @André_Dragosch. I'm also pretty active on LinkedIn, more or less, but not so much on Nostr, which is the shame. Maybe I should start posting more on Nostr, but I have an account, but I'm not so active. And you mentioned Exponential Gold. So the book was published in June last year, and it's supposed to be an institutional investor's guide for Bitcoin crypto assets. Also includes like around 30 pages about like financial history and why Bitcoin is valuable. Because I do think in order to understand the utility of Bitcoin, you need to understand like how the monetary system works, right? Where money comes from and so on. And yeah, all of these topics are covered. Plus, it's essentially like a practitioner's guide. If you're like a professional portfolio manager and you don't know how to approach this topic, how to implement like Bitcoin investments into your portfolio, multi-asset portfolio, then this book is like perfectly suited for you. And yeah, you can find it on Amazon, and also if you go to exponential-gold.com, you can also find the link. Yeah.
Awesome. I really recommend people buying and reading the book. I did too, and I really enjoyed it. So thank you for coming on, Andre. I really enjoyed our conversation. I always learn a lot from you. So thank you. And hopefully we'll do this again in the future.
Thank you so much, Johan. It was a pleasure. Thank you.
All right. Thank you. Bye-bye.
Bye.